Hey everyone, what is going on? It is K2 Investing here. My name is Karen, and today I'm going to go over 6 different tech companies that I plan on adding and I'm watching into my Robinhood portfolio. I'm going to go into every single one of these companies and explain to you exactly why I think they're a good fit for my portfolio. And as always, I empower you guys to do your own research. All the information I'm about to give you, I hope you just use as a guideline or supplemental information to your own research. It's really important that you make sure it is a right fit for your own personal portfolio because everybody is different in their own way. I am going to mention a 7th company at the end of this video. I don't want to go too in depth in it because it's such a big company that it would make this video extremely long, but it is worth mentioning for you guys to add to your own list of research that you want to do in the future. But before we jump into that, I want to go over my overall portfolio performance so far over the past week. On Friday, my portfolio is sitting at $20,414.71, up $632 on the day. As you can see, it was very volatile. It started out strong, dropped back a little bit, and then started to recover. On the week, very red, started off strong here on Monday and Tuesday, and then as you can see, it definitely pulled back. On the month, very green, up 16%. 3 months, also very green. You can see that we're definitely starting to see higher highs and higher lows. On the year, being able to see very clearly just how much that corona pandemic hit us, but again, seeing those higher highs and higher lows. And actually on Monday, when I made my last video, this was green, but because the past week we did have a little bit of a pullback, it has put the year back into the red. And overall, again, still very red here, but at its worst, my portfolio down about 30%, but now sitting at almost 7% down. But it's still either way exciting to see this number because my personal goal is to hit 25K so I can start having a more aggressive approach with my buying and selling within my portfolio and not have that PDT rule that keeps you from being able to trade multiple times in one day. So again, I'm very excited to see that it's getting closer and closer. This pandemic would have never happened. I would have been sitting extremely close, but woulda, coulda, shoulda. You can't change any of that. But pushing forward onto the 6 different tech companies. The first one we're going to go into is ticker symbol BABA. All right, so this group holding engages in providing online and local marketplace and retail and wholesale trade. It operates through the following business segments: core commerce, cloud computing, digital media, and entertainment. This company was founded in 1999. And it was a PE ratio of 26.69. Currently does not have a dividend yield. What's really important to know about this corporation is it has a lot of good businesses in the company when it comes to its e-commerce, streaming content, and its cloud. It is also on a couple different resources that I found, known as well on its way to a large cap like Amazon and Netflix. So a lot of room and a lot of potential to grow, like those other very reputable companies I just mentioned. And also the chart growth is extremely strong. If we look at the 5-year here, you can see just how green it is. So it has an enormous amount of growth and is considered a long-term buy and hold when you look at the chart in this perspective. I hear much talk about this company, which is why I think it's extremely important to do your research because you will find little gems like this, but it is under one of the 100 most popular. But again, I feel like this company is a great buy for your portfolio. Next up is Facebook. So we all know a lot about Facebook. Myself, I do own a Facebook, but it's deactivated 99% of the time. I don't use it very often. I'm not a big fan of social media, but I do understand the importance of it and just how convenient and nice it is actually to have social media. Every time I have it activated, I found myself on it way too much, so I ended up deactivating it the majority of my time, but whatever. But what's nice to know about Facebook is it operates as a social networking company worldwide. The company engages in the development of social media applications for people to connect through mobile devices, personal computers, and other surfaces. This was founded back in 2004, PE ratio of 31.32, and it currently does not have a dividend yield, but it does have great growth potential. One thing about Facebook is just how versatile it is. It is very user-friendly, and it has a lot of other small businesses within its own company when it comes to its use on Messenger, Instagram, the Facebook Marketplace, and it makes it extremely user-friendly for people to be able to interact not only with each other, but to be able to make money and to expand their own businesses. So its usage continuously goes up, whether it be the screen time in general or just the accounts that are made. It also has one of the best balance sheets currently in the market. If you don't know what a balance sheet is, it's basically a company funds coming in versus its funds going out. So it's what it makes as opposed to its debt. Just like if you were to get a credit report on yourself, how much you have coming in versus how much money you have going out is very important. And again, it's one of the top balance sheets in the market today. It is always consistently growing, and it always beats out its really big competitors like Twitter. And this is definitely considered a long-term buy and hold. On the 5-year chart is exactly where you can see just how much this company has grown. Of course, it had big dips like any other company, but it always seems to rebound and come back and rally. So I personally think Facebook is a great addition to my own portfolio. Next on the list, ADBE, Adobe. Now, if you're anything like me with my job, I do spend a lot of time on the computer, and one of the biggest applications I currently use when it comes to signing documents and any type of digital media, Adobe seems to be the king when it comes to all of that stuff. So here, Adobe Inc. engages in the provision of digital marketing and media solution and operates through the following segments: digital media, digital experience, and publishing. It was founded in 1982, has a PE ratio of 53.6, and currently also does not have a dividend yield. But one thing to note with Adobe is every time its expected earnings come out, it always seems to rise above it. And as we mentioned before, it is known as a digital media giant. So it's definitely outperforming its competitors. And just in general, its growth, looking at the charts, consistently outgrow the market. So looking at it, very, very green. Again, having its dips, but always bouncing back. And I did read on a couple different sources that Adobe is kind of considered right now to be overvalued. So it might not be the greatest time to get in at the very moment, but it is definitely something that's going to be in my watch list that I'm going to continue to monitor over the next couple of months, see if I can get in at a better entry point. But regardless, I feel that Adobe is a great addition to my portfolio on the overall growth of the company. Next, STM. So STMicroelectronics manufactures and markets products which offers discrete and standard commodity components, application-specific integrated circuits, full custom devices, and semi-custom devices for analog, digital, and mixed signal applications. So it's all the nuts and bolts inside of a lot of different devices. This was founded in 1987, PE of 22.27, and this one does have a dividend yield, a little bit small at 0.79, but there is dividend opportunities. This company is known to have a higher than average cash income, meaning that cash assets are very important when it comes to a company because that gives them the opportunity to expand their projects. They have more availability for risk to put money into more experimental stuff, so it really helps a company branch out and go above its competitors. It has had what's known as double-digit growth earnings, and definitely in this case, the trend is your friend. As you can see, very green, again, having its dips and its pullbacks, but always seeming to be able to bounce back. And with that dividend yield of 0.79, STM pays out about 75 cents per share on a quarterly basis, and it has been doing so for the last 16 years. It has an overall rating of a 3 when it comes to its dividend payout. And if you want to know how I found out that information, I use a site called dividata.com, so please go ahead and check that out when you're doing your own research. Next on the list, Microsoft. Of course, we have to mention Microsoft. Microsoft engages in the development and support of software, services, devices, and solutions. It was founded in 1975. It has a PE ratio of 31.26, and this one does have a dividend yield of 1.06. Even with the last couple of decades, with technology just growing and growing and growing, Microsoft has continued to be one of the software and technology giants since the 1980s. So regardless of what other competitors throw at them, Microsoft still seems to be able to evolve and adapt to be at the top of the market. Because of that, Microsoft is considered extremely low risk when it comes to buying into their company. As you can see here, its market cap well into the trillions, which not many companies have made it to that milestone in their lifespan. So to be able to hit that over $1 trillion is huge for a company. So again, Microsoft, very low risk, great long-term buy and hold. And that dividend yield of 1.06 means that on a quarterly basis, Microsoft pays out about $1.01 per share and has been doing so for the last 17 years and also has an overall dividend score of a 3. Next, of course, we have Apple. If you mention Microsoft, you have to mention Apple. Those are the two giants in this field when it comes to any type of computers or cell phones or whatever. Apple engages in the design, manufacture, and sale of smartphones, personal computers, tablets, wearable, and accessories, and other variety of related services. Was founded in 1976, has a PE ratio of 26.56 and a dividend yield of 0.91. Also, huge market cap into the trillions. Like STM, Apple is known to have a huge cash and investment asset. So it's known as one of the kings when it comes to that. And again, same idea. They have the ability to really put money into new projects and experiments to help grow their company. And just in general, I think looking around at the people that I know, most people have some type of Apple product, whether it be their watch, their phone, their computer. So Apple is definitely one of those that just all around the company is everywhere you go currently in life. So low risk stock to get into on the 5-year chart. Again, seeing that growth, huge. The dividend yield, not that great, but honestly, it does pay out about 87 cents per share on a quarterly basis, and it has been doing so for the past 8 years. So because of that, it doesn't have the greatest dividend score of a 2, but I personally don't think I can go wrong adding this into my portfolio, and actually I do currently own 1 share of Apple. The last one on the list, guys, that I want to mention, like I said before, that I didn't do too much research on, but it is a huge company, Alphabet, which is also known as basically the parent company of Google and YouTube and all these big subcategories. There are 2 different ticker symbols. You have Class C and Class A. Again, I didn't do a huge amount of research. I'm not sure exactly what the difference is between the 2, but I know that they are both part of that Alphabet company. I think it's a great thing to mention because even if you go, I've looked at both of these ticker symbols and they look generally the same when it comes to the charts. 5 years, very, very green. So again, I don't think you can go wrong. Definitely a little more on the expensive side, but luckily now with Robinhood, if you have the availability, you can buy in partial shares. So you don't have to spend an entire over $1,000 to be able to get this stock. You can buy like half of it or a quarter of it, whichever you are able to afford. But again, I didn't do a huge lot of research on this for the video because it would turn this video into extremely long. So take the time to do your own research because I think that you won't be disappointed by doing so. So guys, that's it. I just wanted to give you a quick recap on 6 companies I'm currently watching and a couple of them that I do currently own, like Apple and Microsoft. I think they're all great additions to my own portfolio and possibly for yours. But as always, I hope you make sure you do your own research and to make sure it's a good fit for you before you make any decisions. If you learned anything from this video or if you found it useful in any type of way, please hit that thumbs up. If you have anything that you want to add or any advice or any questions, please put it down in the comments below. I love seeing all your guys' comments and I try my best to interact with every single one. If you guys want to join me on my journey to investing and watch all the videos that I'm going to be putting out here in the future, please hit that subscribe button. But as always, guys, I hope you stay green, you stay classy, and you make your moves with that kinetic knowledge. Take it easy.